Hello and welcome to Author's Note with me, James Mackintosh, standing in for John, who's away. Markets are up a little today, led by Spain and Italy, where bond yields have been falling sharply. Further improvement in sentiment about the prospects for European bailout. Today, though, we're going to be talking about what's going on in the US, particularly the prospects for QE3. With me, I've got Jamie Chisolm, who's the FT's global markets commentator. Jamie, it takes two to make a market, and we rather disagree on the prospects for QE3, or at least what the market is telling us about the prospects for QE3.
I think we do a little bit, yes.
Perhaps if we bring up the chart, you can see here the US Treasury yield. I've marked on it previous major events about QE. This was when Ben Bernanke first raised the prospect of QE2, when it actually happened, and when Operation Twist happened. And we're now seeing a sharp rise in bond yields. Jamie, what do you think that's telling us?
Well, I'm going to be a bit radical here, James, and I'm going to suggest that, dare I say it, we're starting to see the return to a bit of normality.
Okay.
Bond yields should be going up if things are getting better. Now, I know you disagree, but what we've seen recently, in particular, with the US economy, has not been quite as bad as people have thought, and crucially, there's been one very big element that's been missing from any meek recovery there has been, and that's the housing market, and we're starting to see evidence of traction slowly building the housing market. Now, I may be too optimistic on this, but I think that what we're seeing here now is people starting to say that yields cannot be at such a low level, even if things are just improving slightly.
Well, that is plausible. On the other hand, it could just be that people are saying, actually, things are bad enough that we're going to get some QE3, and QE3, bizarrely, seems to have the opposite effect of what you'd expect on Treasury yields. QE, of course, being the Federal Reserve going out and buying bonds. In principle, having more buyers should push bond yields down. In practice, what actually happened is, with QE2, bond yields rose very sharply. With Twist, bond yields rose very sharply. Didn't last very long that time, but they did rise very sharply, even though there was more buying of the bonds going on. And again, if you were a trader expecting there to be more QE3, maybe you would this time again be selling bonds and shifting into riskier assets.
I'll come straight back at you. What about the fact that the dollar, even though it's been a little bit softer over the last few weeks, has generally been trending higher over, say, a 15-month period? If you look at the channel, it's been going higher.
I would say the dollar has been doing broadly that. It has indeed been trending higher, but it's recently, not as sharply as this, but over that same period, the dollar has been weakening again. I mean, your explanation could also work for that, of course. If people are more confident about the world economy, about the prospects for the euro and other areas, then they won't be quite so desperate to hold dollars, the safe asset.
Let me ask you this question then. If you're saying the market is already pricing in QE3, what does this mean for equities, given that we're now, as we speak, I'll give a timestamp. On Friday morning, the futures are suggesting we're only about 3 or 4 handles on the S&P from post-cyclical highs. Is there a chance of disappointment then in the equity market?
I'd say absolutely. And even more, actually, I'll come back at you on the S&P. We're at a new high if you look at total return, which is what really matters to investors.
Quite right.
People who'd reinvested their dividends have now made money, more money again. So,
and what is gold telling us? Because at the moment, gold started to pick up a little bit again, which sort of goes against my argument. Some people will say it's about QE3, but I'd say that, to be honest, I don't think you can read much into gold. It just seems to do whatever it wants to do.
Yeah, I think gold did work quite plausibly with other assets up until late 2011, when it moved in line with the real yield on US Treasuries. Since then, it's been all over the shop. I'm not sure gold is telling us much of a story right now.
Well, we're agreeing to disagree.
We are indeed.
Pretty much everything.
As I said, it takes two to make a market. Thank you very much, Jamie.